Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab. And this is Long Verticals and Diagonals. And today, we're going to be talking about why some traders choose to trade long call vertical spreads versus just buying a long call. What are the pros and cons of one approach versus the other? Well, today, we're going to be doing a comparison. It's kind of a strategy showdown. Should be a great discussion. Before we get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. I already see a lot of familiar names, and actually some even a little bit more familiar than others. But in any case, hello there, Paul and Andrew, Joseph and Josh, and who else is out there? Bush 8531, Marcus, Len, Life in the Fast Lane, Irma, Greg, Jackson, Kevin, Muralai, Janelle, Harry, and everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. I wanted to say, when those names first started popping up there in the chats, I saw Paul and Andrew and Joseph. And interestingly, it's interesting to me, my dad's name is Paul. I have a brother named Andrew Joseph. So, yeah, familiar names out there. If you are here for the very first time, though, I want to welcome you as well. And if you're watching on the YouTube archive, after the fact, we'll enjoy the presentation, but be aware that you're invited to join us in this live discussion. This is a Thursday webcast series. We kick things off promptly at 11 Eastern time. Love to have you here in the live stream audience. And as a special treat for my live stream audience members, we have my very good friend Brent Morris hanging out in the chats. He's going to be addressing any questions that I can't get to just during the natural flow of the presentation. Thanks for having my back there, Brent. And Brent and I would like to issue an invitation to everybody listening. If you have an account with X, you should be following your favorite presenters there on X. The best place to connect with us in between these live streams, you can find Brent on X at Brent Moores CS. You can find me there at Cameron May CS. But let's get into this discussion. And as we do, of course, there is risk associated with the strategies that we're discussing. So this is important information. Please bear it in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as your sole means of investment research, and investing involves risks, including the loss of principal. Okay, so with that important stuff accomplished, let's set the agenda for what we're going to be talking about today. This webcast is part of an ongoing series, so we're going to be following up on some previous trades. That's the first thing that we're going to do. Look at our current three example trades in our paper money portfolio. Then we're going to take a quick glance at the S&P 500, see what stocks are doing to set the sort of backdrop for the sorts of markets that we're delivering these discussions in. And finally, we're going to move ahead with planning and placing one of two bullish strategies. We're going to be comparing why some traders choose to trade long call vertical spreads versus just buying a long call. I'll lay out some of the pros and some of the cons of each of those strategies so the trader might make a more informed decision if these strategies are playing a role in their portfolio at all. But in any case, then we'll go ahead with an example trade. All right. I'm really looking forward to this. So let's get right to the platform. I'm going to go to our paper money. We can already see our Apple outlined here. But if you weren't here for this discussion, last week we entered into a long call vertical spread on Apple, bought the 222.5 calls for the 19th of September, sold the 225 calls for the 19th of September. So the preference here is for the stock to go above and to stay above and to go as far above $225 as possible, get above that vertical spread. You can see right now the stock's market price is at $231.34. It's actually cooperating nicely. So if you like to see things visually, here's our 225.5 call, represented by this dashed vertical lines. These drawings, if you're wondering where they came from, I just drew them on the chart. But we own the 222.5 call, sold the 225 short. So we prefer to be up above, up here in this green zone as we move toward this 19th of September expiration. And you can see since we took this trade, stock has been very cooperative. Up 5 days in a row. Great. Let's make it 6, 7, 8, 9, 10. That would be better. But as long as we're up above 225, that's where we'd like to be. We do have orders in to take us out if we were able to accomplish at least 80% of the original maximum gain, or if things start moving against us, try to stop out with not more than 50% of the original maximum loss. Now, that's not a guarantee. We could lose more than that. But there we go. That trade is doing fine. We're going to let that work. Next trade that I wanted to explore here was our alphabet position. This is a long call diagonal spread. Bought the 16th of January of 2026, 180 call. Obviously, when we own that call, we prefer for the stock to go up. That one expires in 141 days. We sold the 19th of September 215 call. So with this trade, what we'd like to do is to see the stock go up, helping our 180 long call, but stay below 215 through the 19th of September. Try to get that short call to just expire worthless. And so let's go see what's going on with Alphabet. Here we go. So here's the history of our trade. We actually entered into this long call back here on July 24th. Bought this 180 long call. Along the way, we sold a 205 short call. That's already been closed for a small profit. We saw that that was getting really close to going in the money as it was approaching expiration. So we closed it out. We moved that to a 215 short call, and our stock is moving. It's helping out this long, getting closer to that 215. Now, if this starts to go in the money, that can really start to dial up the risk of early assignment. Even an out-of-the-money contract can be assigned. It won't be in paper money. Paper money doesn't experience assignment on, or doesn't experience early assignment on short options, but that can certainly happen in real life. But right now, still out of the money, but moving in the right direction for our long. That one looks fine. And you can see this trade's done well since we took that position. So finally, that brings us to our GILD position. And I do think there's something we need to do with Gilead. So with this one, we own a $95 call, sold the 125 call. This one has a pretty extensive history. Let's look at GILD. So we bought this long call a long time ago, back in January, but we've been riding the highs and lows as the stock has worked its way higher. So the long call is actually doing well. Along the way, we've sold some short calls, generally for profits, a couple of times for losses. And right now, we're in a 125 short call. That's way up here. And you can see the stock has been moving away from that. So guess what's happened to the value of that premium that we collected? That thing has gone down. And I think we sold for 145. Yep. And it's worth about 14 cents right now. This trader could get out if, assuming we can fill for around the current price, that might be about 90% of the maximum premium offered here. We could potentially exit for about 90% of the maximum theoretical gain on that short option. So I think we're going to do that. Let's get out of that. But at the same time, maybe we'll consider getting into a new position up here. But where might the trader do that? We could move out to maybe October and sell another 125 call. That's quite some distance out of the money. That's about $12, about 10% out of the money. Or this is what I think we might do. What if we were to sell maybe the 120 right around here? We could go to September. There might be, I think there's maybe 50, 60 cents in that option. Or we could push it out here. How about we do that? Let's look at selling that 120 call. So I'll just edit the properties of this line. This is just to show a short option. That's the red. It doesn't mean bad. It doesn't mean good. It just means sold short. And let's see if we can get out of this one for 14 or 15 cents. So I'm going to go to the trade tab. Actually, let's go to the monitor tab and do it this way. Let's go to that 125 call. And I'm going to right click on that and create what's called a rolling order. That means that we're going to use the same order ticket to get out of the one option and into another. We're rolling from one position to another. And we're going to close out all three of those contracts. It's going to describe this as a calendar. All a calendar is a long option and short option on the same order ticket, same strike, different expirations. So we're not technically going to wind up with a calendar, but the entry of the order is essentially the same. So here's the buy order to buy out of the 3 short contracts that we already have at 125. But let's sell, and let's choose the expiration of, let's see, what was that? That was going to be what were we looking at here? Looking at the October 17th. Let's go out there, that third Friday expiration. So let's sell that October 17th, and we'll call that the 120 call. Looks like we might be able to do that for about $1.24 credit. Let's say for this trade, let's say that we're willing to settle for even the natural, even if we can just get $1.20 credit out of this trade. All right, let's click confirm and send. It's going to say selling a diagonal, but essentially closing out the existing short contract, getting into a new short contract at a future strike and a lower strike. Here we are. The diagonal is the 17th of October, 19th of September, 120 to 125. Looking to do that for a 120 credit at least. If we're able to get that, subtract the commissions, that would give us a minimum acceptable credit for this roll of $356. That represents the new net profit potential after accounting for the cost of buying out of the one that we're in. All right, anyway, let's send this order off, see if we can get that filled. I suspect it'll fill pretty quickly. Yeah, we're only asking for $1.20 credit, where the current market value of that diagonal, $1.25, yeah, we got $1.27. So great. So if I go to that monitor tab now, and we look down at our current positions, out of the 125 for September, into the 17th of October, 120, and it looks like we sold that one for $1.42. Cool. So out. Let's go up here to our filled orders. Looks like we closed that current position out for 15 cents. We originally sold it for $1.45, so that's now $1.30 realized gain. So this one, let's edit the properties of this. That's a 130 profit. I'll change that to pink to indicate that that trade has been concluded. Let's edit that one. We close it out today on the 12th, and we'll change that one to pink. There we go. So we're done with that one. I'll put in the details of this new position after today's webcast is over. But that brings us, that wraps up things for our current positions. John says, I'm not in on this trade. What kind of a trade is this? So John, good question. So this one is what's known as a long call diagonal spread. Now, if you weren't here for these trades when they were originally placed, and we've been making adjustments to Gilead for months now, you can find the entire trade history. Everything that I do is done on camera. If you want to find when these trades were placed, the logic of the positions, all of that, you can go to our Trader Talks channel on YouTube. And by the way, if you haven't subscribed to the channel yet, do yourself a favor and click on the subscribe button right now. You can go down the lower right-hand corner, click on that subscribe button. It only takes a second. It doesn't cost anything. But our YouTube channel is where we house our playlists for our previous webcasts. So for example, if I were to look up Trader Talks Schwab Coaching Webcasts on YouTube and go to the playlists here, I could scroll right on down through. These are all the different webcast series that we have. Mine happens to be closer to the bottom. So as we go right down here toward the bottom, you'll see long verticals and diagonals. I can look at the entire playlist of previous webcasts. Like last week, you could go through and revisit the logic of that Apple long call spread that we entered. That was recorded right here. All right, so let's get back to adding a new position to the portfolio. And so Arif is saying, should I close Apple or wait? Okay, good question, Arif. I can't ever tell a trader what they should do with their position, but this is a trade that is doing pretty well. It's not at max gain, but it's moving in the correct direction, at least so far. That can turn around at any time. But when we originally entered this trade, you can see the difference between the two strikes, 865 minus 710 is $1.55. On a $2.50 wide spread, that left 95 cents for potential profit. So really, on a $2.50 wide spread, what did we do here? Yeah, that's exactly right. Did the numbers? I just had to double check my math in my head. Sometimes I get ahead of myself. Yep, numbers are correct. In any case, the best case outcome here is to see this difference of $1.55 grow to a difference of $2.50. That's where the trader would recognize it pretty close to max gain. Well, you can see right now that difference is about $2.10. We actually have an order in to get us out if we can get out for $2.30 right there. So when the trader decides to take profits, is up to them. If we've gone from a 155 value to a $2.10 value, then technically we're looking about a 55-cent gain, right? We've decided not to get out yet. The trader would just have to weigh for themselves. Is this enough? Do I want to get out? Am I willing to take the risk to hang on longer to see if I can get more? Because if the stock reverses, we could lose as much as the full value of the original investment, $1.55. Okay, there we go. So I'm going to let that one continue to work. It's doing fine. Could change. We'll see. But in any case, let's go see what's going on with the markets. The S&P 500 having another decent day. Okay, did we touch record highs? Yes, we absolutely did today. New all-time high for the markets, 64.95.44 is our new record. Let's just say that our trader here is trying to decide if I'm going to put on a new bullish trade. And in this webcast series, we talk about two types of trades: long spreads, long vertical spreads, and long diagonal spreads. Those can be bullish or they can be bearish. So an important question is, bullish or bearish? If I'm constantly trying to place bullish trades when the markets are persistently bearish, I don't stand a great chance of making a lot of money. On the other hand, if the trader is consistently trading in keeping with the markets, if the markets are cooperative, that can really enhance that trader's probability of success. It's never a guarantee, but let's say that our trader just looks at the way things are and they've decided, maybe they conclude, well, if we've had bullishness for months, then that's been productive for bullish traders. Maybe we can get that for another month, maybe for another month and a half. Let's plan for a trade out here to October 17th. And let's say that our trader's conviction is that this trend is maybe more likely to persist than not. If it does pull back, maybe we have some support here recently. But I'm going to say that our outlook for a hypothetical trader is at least somewhat bullish. Okay. Well, lots of different bullish strategies can be applied here, but among the potential bullish strategies, buying calls is one of those. Buying call vertical spreads is another of those. So what might influence a trader to choose one versus the other? Let's do a comparison. And for today's comparison stock, I wanted to have a look at MasterCard. Let's see if it's still cooperating, and it looks like it is. Here's what's been going on with MasterCard recently. It's also had a great run since April. It had a pretty good resistance level, a potential price ceiling right there around that 590 level. But recently, we finally pushed up and through that after a couple of failed attempts back here in May and June. Finally pushed up through 590. And let's say that our trader thinks that previous price ceiling is likely to act as a new price floor. And even as we look at the most recent candles, as we've been coming down to that floor, a couple of interesting recent developments. Long candle tail right here. Some traders see the long candle tail as potential sign of at least short-term bullishness. Also, we have a bit of an inverted hammer pattern right here after a pullback. And now we're looking at kind of a doji, really looking like traders might be a typical technical interpretation of what we're seeing here is that seems to be a pretty good confirmation of support. Now, some more conservative traders might wait for a strong white candle off of that support as a potential confirmation. Nothing's a guarantee that we're definitely moving in one direction or the other. But let's just say that our trader thinks this looks pretty good. Maybe they think the price is likely to go up. Now, let me zoom back out here for just a moment. Okay. Another thing that the trader doesn't really have to overcome is much of a resistance above where we are right now. There's one touch point here, but in a series of higher highs and higher lows, that's not typically interpreted to be much of a resistance. So let's say that our trader thinks, hey, our stock is likely to go up. So maybe I buy a call. Maybe I buy a call vertical spread. Which one should we do? Well, let's outline some pros and cons of each. Let's come over here to our scratch pad, and I'll just start things off with a long call. Okay. What are the pros of a long call? I've written out a few. I'm just going to tap them out just quickly. As we know, a long call has unlimited upside potential. It also is a pretty simple trade, particularly when compared to more complex strategies, like multi-leg strategies, like a vertical spread. So we have a simpler structure to the trade. There we go. Get my cursor out of the way so you can see what I'm typing. There are fewer commissions compared to multi-leg strategies. And it has a high degree of leverage. So if a trader gets the direction of the stock right, they can really amplify potential returns using a leverage inherent to an option contract. So those are some of the pros that can attract a trader to buying a call. In particular, probably these two really stand out to a lot of traders. Unlimited upside, unlimited reward potential with either high or very high degrees of leverage. All right, well, that was fun, but what are some of the cons? Now, Greg's saying, would you create an alert and wait, Greg? Maybe see if we can get a close above today's high, something like that, like a hold entry. Yeah, I can't fault somebody for having a particular signal that they prefer to see on a chart before they take action, especially with something leveraged, like a long call. But what are some of the cons? Long calls have a higher cost relative to vertical spreads, which comes with a higher risk per share. It also means the stock has to move higher to hit a break-even point for the trade. All of those things are kind of tied together. Right? Another con, that exposure to time decay. When we buy a long option, a call or a put, time is working against that trade right from the start. There's a corrosive effect to our investment. So our trade needs to get up and move to make up for that corrosive effect, or we might wind up with an unprofitable trade, even if the stock moves in the right direction. Also, I think that some people don't like to hear this one, but I don't like to say things absolutely, but this is just accurate for every long option I've ever encountered. It's just the way the math works. Long options, long calls, and long puts are inherently low probability trades. Now, an individual trader might say, Cameron, I disagree because I'm really good at picking long calls or long puts, and I think my probability is strong. Maybe I even have a higher win to loss ratio track record. That's individual to that trader. That's not the real scenario. Trading long options is inherently a low probability approach. It doesn't mean low probability of long-term success. It might, but what it does mean is on an individual trade, if we're just looking at the probability of profit or loss, there is a higher probability of loss. All right. Now, number 4 is interesting. Wait a minute. Didn't I already say this was a pro? That higher leverage can be either a pro or a con, depending on what the stock price does. If we buy a call and the stock goes up, awesome. We can enhance our potential reward if the stock is going up. But if the stock is going down, that leverage works against the trader, and it actually creates a con. So there is a pretty good description. It's not an entirely exhaustive list. I'll bet that some of you could look at this list and think of some other potential pros and cons of these approaches. I'm not making an attempt today to to try to list everything that could be great, everything that could be bad about both of these strategies, but kind of pick some highlights. All right, so there's our long call. Let's do a comparison. Copy this. Let's paste it down below. Give us just a little bit of room so they all fit. There we go. Let's compare that to a long call spread or a long call vertical. What are the pros? Well, actually, what we'll do here is just sort of invert things. I'm going to copy the pros up here and paste them down here as the cons. And I'm going to copy the cons here and paste them up here as the pros. So rather than a higher cost, we have a lower cost generally associated with long call spreads versus long calls. And I'll illustrate each of these using examples in just a moment. Rather than greater time decay, we can actually have lower time decay or slower time decay and even positive time decay. Oh, Cameron, I thought buying options always had negative time decay. Not necessarily with a vertical spread. There's also flexible probability scenarios. Some vertical spreads can actually be set up to be high probability. Others, the trader might choose to go for low probability, which typically is associated with high reward vertical spreads. And for better or for worse, we can lower leverage. I'm just going to skip ahead, go down to the cons. Okay, what about the upside potential on vertical spreads? It's limited. What about the structure? It's generally more complex. And yes, when we have multiple contracts, in and out generates more commissions to be paid. Juan, you like this? You learning a lot? Excellent. Very good. So let's do this quick comparison. I do want to do an example trade here on MasterCard. So let's go look at a long call. If we were to come to, let's say, the 17th of October, we'll just stay consistent with the expiration selected, and our trader thinks that we're going to bounce off of this support level and start to rise. Well, if they were to go here to, what if we were to go to, let's say, let's go in the money on both of these. Stock's trading at 590. What if we were to buy, actually, let me go back to my charts. Yeah, we have that support level around 590. What if we were to buy below that support level, buy that long call? Well, that 585 long call is trading for about $21 if I do a little bit of rounding. A little bit less. It could be a little bit less than 21. It could be a little bit more than 21. Could cost us about $21. One contract, standard contracts of 100 shares, that would be a $2,100 investment. Okay. Well, what if, that is a comparatively high cost. What if I were to buy that 585 and at the same time sell the 590 and turn it into a vertical spread? Well, in that case, I'd be spending $2,100, but also bringing in about $1,800. What would be the net cost if we're comparing the long call to the long call spread? Well, we'd be talking about a $2,100 investment versus a $300 investment. That long call vertical spread could reduce the cost of that trade dramatically. Now, that's not all good, but that's maybe a check in the box for the pros of a long call vertical compared to that long call. Well, the problem is when we sell that 590 call, we have the right to buy shares for 585. We have an obligation to sell for 590. Oops. We now have limited upside. You'll notice how for each decision the trader makes, there's a trade-off. With that long call, if we bought the 585 and that's it, hey, we just have the right to buy shares for 585. If those shares go up to $1,000 per share in the next 50 days, still have the right to buy for 585. Unlimited upside. It's not true with a vertical spread. So, pro, lower cost. Con, limited upside. What about the time decay element here? With the long call, if we buy that option, the stock doesn't go anyway, time starts to chip away at the extrinsic value of that option. And we can see that with the delta. Pardon me, with the theta. Get ahead of myself a little bit here. With the theta, theta starts with T, so does time. That's our exposure to time decay. And you can see if we were to buy this contract here, it has a negative time decay. Well, if we, at the same time, simultaneously sold the 590, turned this into a vertical spread, we'd have 19 cents of positive time decay, almost entirely eradicating the impact of time. And as a matter of fact, it's quite likely we'd see a reversal of that. Time would start working in the favor of this trade as we're getting closer to expiration. So one of the cons of buying long calls, that greater time decay, is one of the pros of the long call vertical spread. Ooh, lower cost, time working less against the vertical spread, or maybe even in the favor of the vertical spread. With a long call option, I said that they are inherently low probability. That's due to that time decay element, and also due to the spread between the bid and the ask when we initially place the trade and as we attempt to get out of the trade. Those factors, that combination of factors, can make these a low probability scenario. Interestingly, let me throw this out there, guys. If we were to buy the 585 long call vertical spread, buy the 585 and sell the 590, is that high probability or low probability? If we just define high probability as a better than 50% chance that we accomplish the maximum gain of the trade, this would actually be a high probability trade. If we look at our delta here, delta can tell us a couple of things. Number one, it can tell us how much the option might move if the stock moves up or down $1, so 55 cents up or down. But it can also tell us the probability of a contract expiring in the money. That's another typical interpretation of that delta. And if we see a delta of 55, that's telling us there's about a 55% chance that this 590 contract is going to expire in the money. And if it does, we exercise our right to buy shares for 585. Someone else assigns their right to buy those shares from us for 590. That's a $5 profit minus the cost to set up the trade. That's maximum gain. So yeah, this would be a high probability, if we define that as better than 50% chance that we're going to make our maximum gain. It's a high probability trade. So this is not, it's not an inherently high probability strategy, but in the money contracts are high probability. Or I should say in the money vertical spreads. Out of the money vertical spreads, maybe the trader decides to go for lower probability because those are going to be associated with stronger reward. But what's the trade-off? We have limited upside potential again. We have to deal with a more complex structure. I think you can see that already. There are more commissions to be paid. And there's also, just for better or worse, lower leverage with these long call vertical spreads. We just see a trader here who maybe bought the 585. The stock goes up $1, they make 60 cents. Awesome. If we buy the 585 and sell the 590, the stock goes up $1. Ooh, we made 60 cents, but at the same time, we lost 60 cents. The net increase, 5 cents, not nearly the leverage. Okay. But guys, there's a fairly quick breakdown of the pros and the cons of these strategies. So does this sound like, I want to bottom line this, does this sound like I'm promoting one strategy over the other? Because I certainly hope it doesn't. There are pros and cons to both. I hope we can see that. A trader who is highly confident in the direction they think the stock is likely to go, and they want to maximize the upside potential of that scenario. Which option strategy might they choose if they're choosing between these two? They're probably going to go with the long call. with its associated risks. If the trader, maybe they just think, you know what, I'm not sure if this is really going to rocket up higher than 590, but at least I'm relatively confident that we're going to stay above 590 to some extent. That could still work out optimally well with the long call spread. So for today's trade, let's go ahead with our long call spread. We've been talking about the 585, 590 spread. We could choose any other number or pairing of strikes. I'm going to use this one as our example trade today. Quick way to place that trade is to come up here where it says spread single. I'm going to change that to vertical. It just pairs up the strikes with each other. So then I can come to the one that I was talking about and just click on the ask price to create that buy order. All right, looks like our mid is around 308, our natural's around 360. Let's say we're willing to spend, I'm going to dial it pretty close to that natural, try to increase the likelihood of getting filled on this trade. Let's see if we can spend 350 to get into this trade. If we're spending 350 on a $5 wide spread, that leaves $1.50 for reward. Okay. While we're at it, let's put in a couple of orders to take profits or to try to trim losses if this trade goes well or if it starts to falter. So I'm going to change this from just placing a single order. Let's change this to a first triggers OCO. This is going to allow us to put in 2 sell orders. All right, and 350, that's a $350 investment on a single contract. Let's say that we're willing to spend up to get 10 contracts. That'd be a $3,500 risk. Now, let's right click, and I want to create an opposite order. What I'm going to be doing here, I'm going to be doing this fairly quickly, going through placing the profit and loss entries. If you want to see this maybe at a slowed down rate, go back and watch last week's discussion. That long call spreads explained, strike selection, live trade example. We talked through placing these orders a little bit more gradually. Right? But let's go back here. So let's first of all place our order to take profits. And let's say that our trader wants to take those profits if the trade has grown and then get out with at least 80% of the maximum gain of the trade. On a 350 investment that we're hoping to see grow to a maximum $5, that leaves a $1.50 potential reward. So let's do some quick math here. If $1.50 is the most the trader can make, 80% of that is going to be $1.20. So if we buy for 350, we want to sell if we've made at least $1.20. What's 350 plus $1.20? That's 470. Okay. So I'm going to right click here. Let's create an opposite order to sell, to exit, if we can sell for at least $4.70 and realize at least $1.20 profit. I'm going to make that our limit order, good till canceled. Now, if the stock starts to misbehave and our spread, instead of growing in value, starts to drop in value, maybe the trader just wants to stop the bleeding. If they've lost, let's say, half of their investment value, so in other words, if their investment has fallen from 350 down to $1.75, maybe they just want to pull a plug. That's just an example percentage. Not every trader does it that way. But let's right click up here and create an opposite order that is a stop the bleeding order, good till canceled, if the value happens to fall down to $1.75 or less. There we go. So now let's click confirm and send. We're going to buy 10 of these vertical spreads. The 585, 590 calls, 350 is what is the maximum that we're looking to pay. If we can sell that for 470 and take a $1.20 profit, great. Or if it falls by half and we have to take a loss to $1.75, we'll do that. Now, there are commissions to be paid on this trade. That is to get in and also to get out. But let's send this order off. And of course, there's this reminder down here. due to potentially wide markets or liquidity risks at the time of activation, it's referring specifically to the stop order may be manually substituted with a limit order upon activation and worked until filled. And I just want to emphasize, just because we placed our stop at $1.75 doesn't mean that that's the guaranteed execution price. We could fall through that. Let's send that order off and see if that fills. I think it probably will. Yeah, we're willing to pay a $3.50 debit. It's only trading at $3.08. Probably going to fill for less than $3.50 if I were to guess. We'll see. We'll keep an eye out there. So yeah, filled that at $3.15. Great. All right. So Vic says they're an example of a credit spread trade with OCO in the archives. Yes, Vic. I can't remember which one it was though. You just have to kind of go back and look through the archives. Maybe I'll do another one here pretty soon. It's not going to be in the archives of this webcast though, because we only do long debit spreads. But in any case, guys, we've done what we set out to do today. I hope you enjoyed that presentation. I just wanted to weigh the pros and the cons, why some traders might choose long call spreads over long calls. However, others might actually choose the long calls. I'm okay with paying the higher price. I'm okay with the lower probability. Want that leverage. That's the way that trader might be thinking. But guys, this is what we do on Thursdays. I hope that you'll put it in your calendar to join me each Thursday or to just watch the archive. That's a great way to do this too. Just watch the videos on demand. But I want to make you aware of other resources that you have outside of just these live streams. Number one is to make sure, if you haven't done it already, that you've subscribed to our Trader Talks channel on YouTube. As I mentioned earlier, it only takes a second. You can go down and click on the subscribe button right now. It only takes a second, doesn't cost anything, but this is where we house our previous webcasts. So you can look up Trader Talk Schwab Coaching webcasts on YouTube, find the playlist for our previous webcasts right here. You can join live streams here. You can even do a keyword search. I'm going to experiment here. Let's look for an OCO Reddit. I don't know. I don't know if anybody's put that in their title explicitly. I'm guessing this is probably going to do it. Yeah, probably one of these. But that was your question. Can we do credit spread OCO orders? Yep. Check one of those two out by Connie. But in any case, another resource for you is to make sure that you're following your favorite presenters on X. You can follow Brent on X at Brent Morris CS. You can follow me there at Cameron May CS. But this is the best place to connect with us in between these live streams. I'm very active on X. When I make a post here and you reply to one of my posts, I reply right back to you. So for example, recently I asked this question: which factor do you think drives stocks the most through the end of 2025? Gave a few choices, but also asked, is there something else you think might be driving stocks primarily? Is it interest rates, earnings, tariffs, or something else? About 45 people have replied to me. I've replied right back to them. But it is the best place to connect with me in between these live streams. I even have a 4-day weekend coming up. I'm not going to be in the office tomorrow. We have the holiday on Monday. That's where you'll find me still. But also thank you to everybody who has already clicked the thumbs up. I can see 150 people watching the live stream. Looks like we have 66 thumbs up already. I think 66 people have clicked the like button. That's always appreciated. It's not just appreciated, it's helpful. When you click that like button, it tweaks the YouTube algorithm and says, hey, people like this video. Maybe we ought to show it to more people. It helps more people find these discussions so they can see things like the pros and the cons of vertical spreads versus just long options. Everybody, thanks for watching. I will see you in a future webcast. I'll also look for you on X. Thanks, Brent. But hey, everybody, whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.